The master speculator, the man who has elevated the game to the level of a science, operates from a completely different and far more patient philosophy. He understands a truth that is invisible to the amateur, that the true, life-altering profits of a great speculative campaign are never found in the initial flurry of activity. They are harvested only at the very end of the move. This is not a paradox, it is the fundamental law of trend-following speculation. The great money is not made in the buying, nor is it made in the selling. The great money is made in the waiting, in the quiet, disciplined, and often nerve-wracking art of sitting tight. This was the central secret of Jesse Livermore's immense success. He learned, through the painful tuition of losing several fortunes, that a man can be right on the market's direction and still lose money. He can pick the right stock at the right time, but if he lacks the courage and the character to stay with it, he will never see a truly significant profit. He will be shaken out by the market's normal, healthy reactions. The principles of this patient, profound approach to the market were chronicled with brilliant clarity by the journalist Edwin Lefèvre, who captured the essence of Livermore's mind. A link to his essential work, Reminiscences of a Stock Operator, can be found in the description below this video, for its lessons are as timeless and as vital today as they were a century ago. To understand this philosophy is to understand the great chasm that separates the gambler from the professional. The gambler seeks the thrill of constant action. The professional seeks the one or two great, decisive moves of a year where the line of least resistance is clear and powerful. He knows that the market does not offer these opportunities every day, or even every week. There are long, fallow periods where the market is confused, directionless, and treacherous. The professional has the wisdom to stand aside during these times, preserving his capital and his mental clarity for the moment when a true opportunity presents itself. The amateur, by contrast, cannot stand the quiet of being in cash. He is lured into the chop of a sideways market, and his account is slowly bled dry by 1,000 small losses and commissions. His desire for constant profit ensures he will never see a real one. This leads to the amateur's most destructive habit, a habit born of fear. He enters a trade, and it quickly shows him a small, promising profit. Immediately, he is seized not by confidence, but by a profound anxiety, the fear of seeing this small gain turn into a loss. He is tormented by the thought of giving the money back, and so, he sells. He snatches his small profit and feels a momentary wave of relief. He whispers to himself the most dangerous platitude on Wall Street: "You can't go broke taking a profit." While this statement is literally true, it is the philosophy of a man destined for mediocrity. It is the creed of the speculator who is content with making a bare living, when he could be making a fortune. It is a guarantee that he will never capture a great move. The mathematics of this approach are unforgiving. A speculator who is constantly taking small profits but, due to the equally powerful emotion of hope, allows his occasional losses to run large, is on a mathematically certain path to ruin. His profits are cut short by fear, while his losses are nurtured by hope. Livermore understood that the only way to win the game was to reverse this formula. A speculator must have the discipline to cut his losses short without hesitation, and the courage to let his profits run. This seems simple, but it is the hardest lesson in the entire art of speculation, for it requires acting against one's most basic human instincts. The source of all true, life-changing profit in the market is what Livermore called the big swing. This is the great, primary movement of a stock or the entire market, a trend that can last for months or, in some cases, for more than a year. It is not the daily wiggle, but the great, powerful tide. To correctly identify the beginning of one of these great moves is the mark of a skilled analyst, but to have the fortitude to stay with that move, from its inception near the pivotal point to its logical conclusion months later, is the mark of a master speculator. This is where the real fortunes are made. The pivotal point, that critical moment when a stock breaks out of its trading range and signals its intention to begin a major move, is not the end of the journey. It is the starting gun. The amateur sees the profit from the initial breakout and thinks his work is done. The professional knows that the real, easy money has only just begun to flow. The initial points of a move are always the hardest to get. They are fraught with risk and uncertainty. The stock must prove itself, but once the trend is established and the stock is acting right, the advance enters its middle and most profitable stage. This is the heart of the big swing. To sell during this stage is to abandon the field in the middle of a great victory. It is to do all the difficult preparatory work and then to leave before the spoils are truly distributed. Yet this is what the fearful, profit-snatching amateur does, time and again. This brings us to the most famous of all Livermore's aphorisms, the one that contains the very soul of his philosophy. It was never my thinking that made the big money for me. It was always my sitting. What is meant by sitting? It is not a passive, lazy, or inattentive state. It is an active, vigilant, and profoundly disciplined form of inaction. It is the art of staying with a winning position, of refusing to be shaken out by the minor, meaningless reactions that are part of every great move. A stock in a powerful uptrend does not move in a straight line. It advances, then it pulls back to digest its gains. It shakes out the weak holders, the timid souls who bought it on a tip and have no real conviction. These normal, healthy pullbacks are terrifying to the amateur. He sees his paper profit shrink and he panics. The professional speculator, the one who is sitting tight, understands that these reactions are not only normal, but are a sign of the trend's health. He studies their character. As long as the pullback is orderly and occurs on diminished volume, he is not concerned. He knows it is merely the market shaking the tree. This sitting is the hardest work in all of speculation. It requires more steel in the nerves, more patience in the soul, and more strength of character than any amount of frantic buying and selling. It is a battle waged not against the market, but against oneself, against the powerful, primal instincts of fear and impatience. How does a speculator know how long to sit? How does he know when the big swing has finally reached its end? The answer is not found by looking at a calendar, nor by looking at the size of his profit. The answer is found only in one place: the ticker tape. The decision to hold a position is not a one-time event, it is a continuous process of reading the action. The speculator must be a master diagnostician of his stock's behavior. The one and only question he must ask is it still acting right? A stock that is acting right is one that continues to exhibit the characteristics of a leader in a bull market. It advances with power and ease. It makes new highs. Its volume patterns are constructive. Its reactions are shallow and orderly. It is following the line of least resistance, which is upward. As long as the tape continues to confirm that the trend is healthy and intact, there is no logical scientific reason to sell the stock. The speculator's personal opinion about the price is irrelevant. His feelings of anxiety are irrelevant. The tape is the final arbiter, and as long as its verdict is bullish, he must have the courage to obey it. This method removes the agonizing burden of guesswork. The speculator is not trying to be a fortune teller, predicting the top of the market. He is a tape reader, reacting to the present facts as they unfold. He stays with the trend as long as the trend itself tells him to stay. One of the greatest psychological hurdles to this method is the sheer size of a large paper profit. A small profit is easy to handle, but a profit that has grown to a magnificent sum becomes a source of immense mental pressure. The amateur begins to see this paper profit as his own money. He starts to count it, to think of all the things he could buy with it. This creates an unbearable fear of losing it. The larger the profit grows, the more terrified he becomes, and the more likely he is to be shaken out by a minor reaction. Livermore trained himself to be immune to this pressure. He understood that a paper profit is not his money. It is the market's potential reward for being right. His job was not to protect the paper profit, but to correctly manage the position. If he managed the position correctly, according to the facts of the tape, the profit would take care of itself. He depersonalized the money. It was just a series of numbers, points on a board. The only thing that was real was the stock's behavior. By focusing on the behavior, not the money, he was able to maintain the cool, detached objectivity required to see a great move through to its end. This leads to another common fallacy of the amateur, the belief that a stock can be too high. He will look at a stock that has had a spectacular advance and conclude that it cannot possibly go any higher. He sells, content with his profit, only to watch in agony as the stock doubles again. Livermore's great principle was that a stock is never too high to buy, as long as the action is right. By extension, a stock is never too high to hold. The price itself is meaningless. In a bull market, a stock at a new all-time high is often the safest stock to own, for it is in a position of demonstrated, unassailable strength. To sell a powerful leader simply because its price seems high is to abandon the strongest horse in the race in favor of a weaker one. It is a failure to understand that the very stocks that seem too high are often the ones that have the furthest yet to run. The speculator must have the courage to follow strength, not to run from it. This philosophy of holding for the big swing is perfectly integrated with the strategy of pyramiding. Livermore did not establish his entire position at the beginning of a move. He would probe the market, and only after the stock had proven him right by showing a profit would he add to his line. He understood that the most dangerous points of a trade are the very first ones. The real, easy and safe money comes in the great, quiet middle of the trend. The amateur, in his fear, is getting out just as the professional is settling in for the most profitable part of the ride. The amateur sees a profit and thinks, I must secure this. The professional sees a profit and thinks, my judgment is being confirmed. The trend is real. Now is the time to press my advantage. This difference in mindset is the difference between a small, temporary gain and a great, enduring fortune. If the true profits are only harvested at the end, then the final and most critical skill is the ability to recognize that end. The end of a great trend is not a single point in time. It is a process. It is a gradual, but unmistakable change in the character of the market. The speculator who has been patiently sitting tight must also be a vigilant observer, watching for the signs of distribution. The same leading stocks that were once so easy to buy and so eager to advance will begin to act heavy. They will churn on massive volume but make no new upward progress. This is the first great danger signal. The market itself will take on a different character. The wild, speculative fever that marks the final stage of a great bull market will appear. The public, which was fearful and skeptical at the beginning of the move, now rushes in, eager to buy anything at any price. The low-priced, low-quality stocks, the cats and dogs, will begin to have their day. When Livermore saw these signs, the faltering of the old leaders and the speculative mania in the low-grade junk, he knew that the end was near. The smart money that had fueled the bull market was now quietly selling its holdings to the eager and deluded public. The time for sitting was over. His selling, like his buying, was not an emotional act. It was a cold, logical response to the evidence of the tape. He did not try to catch the absolute top. He was content to sell into a market that was still strong, but that was showing the unmistakable signs of its own exhaustion. He understood that a speculator is like a farmer. He cannot control the seasons, but he can study them. He prepares his soil in the winter of a bear market. He plants his seeds in the spring of a new bull move. He patiently cultivates his crop during the long summer of the trend. And he must have the wisdom to recognize the autumn, the season of the harvest, before the first killing frost of winter arrives. To snatch a profit too early is to harvest a field of green, unripe wheat. The potential is there, but the true value has not yet matured. The great, nourishing profit, the one that can sustain a speculator for a lifetime, only comes to the man who has the patience and the wisdom to wait for the final harvest. This, then, is the great lesson. It is the most difficult and the most profound principle in the entire science of speculation. The small, nervous money is found in the daily wiggles, but the true profits, the life-changing fortunes, are the reward not for a man's frantic activity, but for his disciplined, courageous, and intelligent sitting. They always come at the end.